I'm Matt Hudgens, and he's Dave Mulvaney, and this is Profitability MD. Dave, how you doing today, buddy?
Great, Matt. How about you?
I am doing all right. I'm in my own house, but just a different location. These are some paintings one of my girls had done. I kind of like the color. It goes with the blue shirt.
That's good.
So we're doing a little repair work in my office. So, all right, episode 157. Retirement plans for small business owners. We talked about the 4 pillars of wealth all the time, right? So you get a business provides lifestyle. You want it to create excess cash flow, so then you can start a retirement plan. So then you could also invest in real estate, maybe your office or some revenue producing real estate. And then your wealth accumulation account, where you're starting to siphon wealth outside your business. So you have other assets that can generate cash flow and generate wealth going forward. So today we talk about one of those pillars, retirement plans, and what the options are out there for small business owners, whether you're a one-man shop or a small business with employees.
Yeah. So, I mean, I had conversation this week with a couple of business owners about the 4 pillars.
Okay.
And of course, I talk about real estate a lot. But when we talk about the 4 pillars, it's surprising how many business owners don't have a retirement account inside of their business, meaning what you typically have is, oh yeah, I have one for my previous company when I worked there. And then I transitioned into self-employment, and I haven't put a retirement plan into place yet. And so I think that's a mistake. And so that's why we're going to talk about this today, because there are a lot of reasons to do it besides just accumulating money for retirement. So,
absolutely. I think you're exactly right. I think that a couple of things on that would be, at first, it's almost like they think they're just going to sell the business, and that's kind of the retirement plan. Right. The second part gets into that is that a retirement plan is expensive or hard to run or hard to do, and there's too much compliance and that kind of stuff. The simple way to start is kind of like your IRA, right? If you make money, you can put money in your IRA. I think it's $6,000 a year this year. Oh, by the way, we've got to make our financial disclaimer. You can this is not financial advice. Talk to your own financial advice, your own CPA, your own tax professional. This is just talking. This is not investment advice. All right, that's our disclaimer. But here's what's out there is IRAs, right? So you can put money in an IRA depending on how much money you make, but it's only $6,000 a year. Okay, that's not a lot of money. Why would you do that? Well, you could have $6,000 to put in retirement, or you could pay taxes on that $6,000 and keep, $3,000 of it or $3,500, right? So you could put money away, pay less in taxes, and now you're starting to build your nest egg, build your retirement pillar. Okay.
Yep.
A lot of people start what they call a SEP IRA, SEP, self-employed pension is what it actually stands for. But if you're a solo person, you're a one-man shop, or whether it's an LLC or whether it's just doing business as yourself, you could start a SEP. Now, a SEP allows you to put away 25% of your profit. So if you're a contractor, a consultant, and you got a side gig, and you made $100,000, you could put away 20% of that, $20,000, into the SEP IRA. The idea there would be, well, if I keep the $20,000, I'm going to have to pay tax on it, $7,000, $8,000, $9,000, depending on what tax bracket you're in. Or I could keep all 10 and put it and start building my nest egg. I'm sorry, keep all 20 and start building my nest egg.
So, and
right?
That would be tax deferred. Is that correct?
Yeah, tax deferred. So eventually all these things you put money in, you don't pay tax today. Eventually it comes out of your 401k and your IRA. It comes out taxable,
and
right?
So
when
I'm just clarifying because
Yeah.
A Roth IRA can't technically be done through a business, right? That's on the personal side, and is that correct?
Well, you can do those. No, you can do those now. So Roth you can do personally now, and now there's a Roth option in your 401k typically. So Roth means that I'm going to put $5,000 in the Roth IRA or the Roth 401k, which means I got to pay tax on that $5,000 today. But if I can pay the tax and still put money in the Roth, I'll never pay tax on that again.
Correct.
Right. So it depends if you want a tax break now or a tax break later. And truthfully, you probably should do a portion of each, right? At least in my opinion. Again, our opinion, not financial advice, yada, yada. And the idea being is that a lot of times when you're a business owner now, you're probably in the higher tax bracket. when you retire, you won't have other income. So you can kind of control how you take the money out and kind of manage your tax bracket.
But let's say you're
but
30
eventually,
years old. I mean, but let's say you're 30 years old, and if you pay tax, let's just say on $6,000, I think is the maximum Roth contribution. If you pay your tax on that 6,000, so let's say you made 8,000, you're taking 6,000, you're putting it in this Roth. Well, it's got 35 years or more to grow. It's far going to offset the taxes you paid on the front end. In most cases, if you make 0.5% a year, it might not. But if you have it in an investment that, I mean, the markets have averaged 12% over long periods of time, so you could do very well. So
yeah, it just depends on what you're trying to do. Are you trying to manage your taxes now or manage your taxes later? And that's truthfully, like I said, a lot of people do a combination of X percentage I want to save in a pre-tax IRA, 401k, a SEP account. So I don't pay taxes today. I'll worry about taxes later. And then a portion you might put into a Roth 401k or a Roth IRA, which means, oh, I got to pay tax today, but then I'll never pay tax again. Now, part of the disadvantage of this stuff, it locks up your money, right? So you're not supposed to take that stuff out until you're 59 and a half, right? So you don't put in, if you need this money to live off of, you can't put money in retirement plans, right? If you need money to pay for your living bills, to pay for your car, to pay for your kids' school, you can't take the money out of this until you're 59 and a half. You have to pay income tax and a 10% penalty, okay?
yeah.
So the idea is you're only putting away what you can afford to put away, right? But it's also delayed gratification, right? That I think Clark Howard and Dave Ramsey say you should, again, this is their advice. So go Dave Ramsey, Clark Howard, it's like 15 to 20% of your income. So if you did make $100,000, Clark Howard and Dave Ramsey say you should be putting $15,000, $20,000 a year into a retirement plan.
I agree. I mean, the reason I agree is because many, many years ago, I think I started a retirement plan maybe in 1994, 95-ish. And I've been self-employed since 92, but somewhere around 1990, my son was born in 94, he was born. And at that time I started the Florida prepaid college program for him. And the 529 plan, which is a separate account. And then I did the same for my daughter. And I'm so glad I did, because and this is what a lot of business owners don't think about. You're struggling in business. I was always struggling in the beginning. Then I did really, really freaking great for a period of 12 years. I did phenomenal. And then I had a one business that just tanked. But because I had been putting a little bit aside for a long time, both my kids had their college funded. I didn't have to take any out of our personal savings. It was all funded, all because I did a little discipline on the front end. So this is one of the reasons why I think it's important for business owners to consider, look, you're in business, but you got to start funding these accounts.
Yes.
Because if you don't, what ends up happening is you're in business 20 or 30 years and you think you're going to sell the business, but you can't sell the business because you are the business. And if you've taken a little off the top for all these years, you actually can do something about it. So back to the SEP plan.
Yeah. So again, if you're a solo person, you're a one-man shop, one person shop, you can do a SEP. Now, one more thing, as a solo person, you could do what they call a solo 401k or an individual 401k. The advantage there is that you can put away more money. So let's go back to that person who makes $100,000 in the SEP. You can put away 25% minus your self-employment. So really the net number is 20%. So if you are making 100 grand and you're a solo person, a SEP, SEP, you can put away 20%, so $20,000. Now, a solo 401k is one step up, doesn't cost any more money. None of these cost any money, by the way. You can set these up for simple, Schwab, Vanguard, Fidelity. There's no cost to these things right now. That's the other thing, by the way, is everybody used to think these things were really expensive and the costs have come way down. So we'll talk about that here in a second. So a solo 401k allows you to put that same number, that 20%, that 20,000 plus a deferral amount of 19,500 plus 6,500 if you're over 50. So it's like, and maybe it might be 27. So if you're 50 years old, you can put away 19,500 plus 6,500. That's $26,000. plus the 20,000. That's that 20%. So now that's $46,000. So you see, if I made $100,000, I'm a solo person and I have a SEP, I can put away $20,000. If I'm a solo person and I make 100 grand and I have a solo 401k, I put away 20 plus another 26 if you're 50 or higher, 19.5 if you're not. So you're putting away 40 to
So
$47,000.
and in the solo 401k, can your company do any matching if it's an LLC or a corporation, or is that only on a
Yeah, technically the matching is the 20%, is the $20,000. Yeah. And then your portion is that deferral, that 19.5 plus the 6,500 catch up. So your portion is 19.5 plus 6,500. So like if you worked at a company, you work at Coca-Cola, Home Depot, you can put away 19.5 plus $6,500 into their plan, their 401k. That's called your deferral. And then Coca-Cola has a matching plan where they'll usually match 3% or 4% of your salary up to what you match. You know, if you make 100 grand, they'll put in 3%, 3 to 4%, so $4,000. If you put in 4 grand, if you put in 3, they're only putting in 3.
Yeah, so we
but
did.
Then
we matched.
Yeah, but then if you put in the 19.5, you're only matching that first 4 grand.
You know, and I told when I had all the employees, we would sit down and I would explain to them when we brought them on the 401k. I said, look, after 90 days, you're eligible to go into our 401k, and I highly recommend you do it because on your first year, if the plan makes zero money, you still make 100% on your money up to 4% of your income.
Your free money, yeah.
So why wouldn't you take that? And
yes.
They, you know, sometimes they think, oh, I'm sure it's not to my benefit. Like an employee thinks the employer is out to get them, but the reality is you're trying to do good for your employees. It's one of the reasons you create a plan like this. So
yeah, that's exactly. So now we get into, if you're a small business owner, so you have some employees, 1 employee, 5 employees, 10 employees. Now you get into, you could do something called a simple, which means I'm not going to put any money for you, but I'll put in money for me and you, or I can match everybody 3%. Okay. So that's a simple plan. Everybody thinks that's the cheapest plan. It is, but there's no deferral in there. There's a smaller dollar amount. I think it's like, I forget the amount, 12,000, 14 grand. I forget the exact amount, but it's a smaller number. Remember when you were solo, you could put away that 20, or the solo 401k, it was 46 number. So now you get into, here's where I talk to a dentist's office or a lawyer's office. So they have a small number of employees. We can do a 401k. And so the benefit, again, by the way, the government wants you to start a 401k if you're a business owner, and they give you, I think it's $5,500 of credit. So whatever the startup costs are, and a little tax credit if you do some what they call auto enrollment and auto increases. So you get actually a tax credit for starting a retirement plan because the IRS wants you to start a retirement plan.
Isn't that interesting that the form you fill out every year is Form 550 or
yes,
5,500?
And
to give you a $5,500 tax credit. That's interesting. So.
All right, I don't know the connection. That's a pretty good point. So you do get a credit for starting one in your company. Why would you want to start one? So let's say that you're a successful dentist and you're making more money than you spend, right? Or a successful lawyer, just whatever the business owner is. And let's say you make more than you spend. Well, whatever, you'd pay tax on that. So let's just use a number. You're a dentist, you make $200,000, you're paying tax on $200,000, roughly, I don't know, that's like in the 24% tax bracket. So you're paying $50,000, okay? 60, somewhere in there. You could start a 401k plan for your employees. What does that do for you is, I say you can pay the government the tax, or you pay less tax and you give some money to your employees, but you end up ahead of the game, right? So there's a whole mathematical thing they talk about where it's like, why would you do the 401k? Well, because then you could put away your deferral, that 19.5 plus the 6,500. I could put away 27,000 if I was a dentist, plus 3% of my salary, or 4% of my salary. But to do that, I have to do that matching we were talking about. I got to give some money to the employees, either 3% across the board, so you know what your salary payroll is and give 3% of that, or it's a participation. I'll give 3% or 4%, depending on how much participation they have. And so then you look at this number, and the number is, well, I can put away this, but it's going to cost me this. And it's always less than what it costs you. You're saving more and you're paying less in taxes than you're giving to your employees, right? So again, I'd rather give the money to my employees because they like me more. Hey, I got a little bonus where I'm giving 3% of your salary into a retirement plan. Whoop-de-doo, that's awesome, right? I'd rather give that than give that same money to the IRS.
Sure, sure. And now, employees, when they're trying to make a choice at a job, okay, every employer wants somebody who's going to come work for them 20 or 25 years. And let's say you're the type of employee that says, I want to go work for there's one company for 20, 25 years. Well, right. If you're going to make the choice, which one are you going to go to? You're going to go to the one that has the benefits. So you got a choice to go to work for two dentists.
Yeah.
One has benefits, one doesn't. Which dentist are you going to go to work for? The one.
That's a great point, especially in this tight environment, right? So having a good benefits package, right? Insurance and a retirement plan is a good thing to have to offer to your employees.
Yeah.
So the next stage up from that. So if you're a business owner with more than one employee, right? Or one employee or more, you do the 401k. Then you could add what they call the profit sharing plan. So think of these as a plan on top of it. It's kind of like the 401k base. They call it a safe harbor, where you do that 3% across the board, or 3 to 4%, depending on who participates. Then you do this profit sharing, and the profit sharing is optional, depending on if you, the business owner, the company, made a profit. And there's a calculation that how much you can give to yourself, to your highly compensated employees, to the rest of your crew, right? Again, the government wants to make sure you're not just giving it all to yourself, right? That you got to spread it out amongst but it still benefits you as the owner. So that's the second component. The 401k, where you're allowed to put away the 19,500 plus 6,500 if you're over 50. Then we get a profit sharing, so I can put a percentage of my profit, percentage of my salary, but I got to do that for your salary too, right? If you're one of my employees, so it's going to cost you more money, but you get to save more money. And then the third and final thing, which is really awesome, is an old-fashioned pension plan. So remember, people used to go work for companies for 25 years, IBM or whatever, and then you get an IBM pension. Well, nobody has pensions anymore because we have these 401ks, but they do have something called a cash balance defined benefit plan. So think of that as I call it the Mac Daddy. It's kind of on top of that 401k, the profit sharing, then this cash balance defined benefit plan. It's long words, I know, but basically it means you can put a ton of money in there for yourself, up to $300,000, depending on your age, because it's age based. And actually, it might be higher than 300, depending on how old you are. What you're trying to do is that works really well if you're older than your employees, because now you're talking about how long do you have until retirement. And if you're 50 years old, you're closer to retirement. So the IRS allows you to put more money in, and your employees are 25 or 30. Well, they've got, 40 years to retirement, so you can put in less money there. So what ends up happening, those used to be really, really expensive, like 30,000, 40,000, 50,000 a year to administer. So this goes back to what I was talking about. All these plans, people used to think they're expensive as hell. And by the way, they usually were. They used to be really expensive to do these Mac Daddy ones. Even the basic 401k plan was usually insurance companies, and you're paying. There are a lot of small business owners that I come across that are using insurance companies to do their 401k plan, and they're paying 2.5%. Okay, you can now build these plans for 1%, 1.5%. So most of the guys were using insurance products for their 401k plan, and they're paying 2.5%, sometimes even 3.5%. And now, the competitive market, the prices have come way down on the basic safe harbor 401k. So you can do that for 1%, 1.5%. And then these cash balance defined benefit, the Mac Daddy plans used to be obnoxious because you got to do all this IRS testing and all this kind of stuff. But now with technology, that's all computers. So these guys can do these things for less than $10,000, $5,000, depending on the size of your plan. The reason I say that is what this comes back to then is you can come up with any plan in between. Do you want to save $20,000 a year? Do you want to save $300,000 a year? And you can build a plan anywhere in between there. And this is where you get the actuaries and all this kind of stuff. But whatever your comfort level, you can build a plan. And why would you do that? Again, let's go back to that dentist or that lawyer. And it's, you got 5 or 10 employees. And the idea is that I'm either going to pay the IRS or I'm going to give it to my employees. So in these big Mac Daddy plans, you're going to be surprised. You might be paying 10%, 12% that's going into the retirement plan for your employees. So if you've got an employee that makes $100,000, you're putting $10,000, $12,000 in their retirement plan. Well, why are you doing that? Because you're putting away $200,000, $300,000 in your own retirement plan. So on a basis, if you kept that $300,000, $200,000, well, you'd be paying 40% in taxes, $80,000, right? Well, I can either give my employee 10,000, 12,000, right? Or I could pay 80,000 in taxes,
Yes.
right? It works out better that you can give your employees this really kick butt benefits package, right? And it's now really differentiating. What other benefits package are the people paying, 5%, 10% of their salary into a retirement plan for you?
Yeah. And
Anyway, this got all complicated, but you understand where I'm going.
It really, it wasn't, I'm glad you're being a little complicated, because the reason this is so important is, I mean, we know why it's so important, but I think a lot of business owners, you mentioned it earlier, they plan on selling their business as their retirement.
Yeah.
But here's the reality. When you get to retirement, a lot of people think, well, I won't need as much money when I retire. The reality is, if you retire at, let's just say you retire at 62 years old, I promise you, you'll spend more money retired than you will when you work, because you're going to be traveling, unless you're a hermit and you're going to live in a small apartment, and that's a different story. But if you want to continue enjoying your lifestyle, because most self-employed people build a great lifestyle, you've got to plan ahead for that lifestyle. Sure, you're going to get Social Security maybe when you're 59 and a half, or you're going to wait till you're 65 or whatever, but you'll have that. You and your wife, if you're married, you might have that, but then you can have a retirement account. Then you can have some real estate investments, all of this, so that once you're done with your business, whether you sell it or not, or whether you're able to sell it or not, you've got this cash flow that comes in from these various directions. And one of the best directions is to avoid paying taxes over a period of years. You're still going to pay tax, but to minimize your taxes and give employees benefits, so that when you get to that, you've got this one pillar and it's built. And that
it's built, and it was funded by the business over a period of years, right?
Yeah.
So that you're exactly right. That it's, why wouldn't you have a retirement plan? It's good for your employees. It's good for yourself. It defers it refers your taxes. It forces you to save, right? Forces you to save money. You pay less tax now. It creates a nest egg that will generate income for you in the future, right? You're exactly right. And it's just, people forget about it, right? It's like you said, it's like I'm building this business and I need to put all my money back into cash flow. Yeah, but it's really diversification, which is really what our whole 4 pillars is about, right? You got your business, and you're not going to put all your money back in your business. I can't tell you how many businesses I had. This was a new prospect probably a month ago, and really high income earner, but he lives a very reasonable life. And he's like, I just don't know where all the money goes. I don't know where. It turns out all the money keeps going back into the business, right? There's always new software to buy, or a new piece of furniture, or new equipment to buy. He doesn't realize he's not living off of what he's making. He's taking his money and put, that's fine, but he's putting all his eggs in one basket. Why not diversify? Put some of the money back in the business, put some of the money into real estate, put some of the money into a retirement plan, put some of the money into your wealth accumulation plan, right? That's how you build the pillars. I can't tell you how many guys are just putting all their money back into the business. And what that weakness, like we've talked about, well, what if the business hits a rough spot? You've been putting all your money back into the real estate. Guys do this all the time in the sense of, especially developers, they put money back into the next deal, right? And then the last deal crashes and you lose all your profits because you've been putting all your profits in for years until the last deal crashes.
And developers they tend to be a little slow because they usually do it about 2 or 3 times before they catch on. So,
that's right.
But the thing about that is, Matt, what your business, I don't care what business you're in, your business will eat every dime you see.
Yes.
So what we're recommending is take some of the money, plan to take it off the top so you don't see it. It's not seen now, because whatever's there, you will spend. That's why I always talk about isolating cash when but this is an isolation of cash into a retirement for you and your employees, and you don't see it. I mean, but then you get 15 years down the road, you're not going, oh, where'd my money go? You can see this big nest egg that you built for yourself, and it feels great. And it's never too late to start, whether you're 52, whether you're 55, it's never too late to start. But when was the best time to start? Would have been 15 years ago. The next best time to start would be right now. So, yes. I mean, of course, we're not giving advice. any
No, no,
specific-
but it's just one of the pillars, right? It's really great stuff because, like I said, I can't tell how many people they don't have a retirement plan, or they have a retirement plan they're paying too much, right? So you should go get it evaluated. See, nowadays, again, this is just advice in general, right? Go find somebody to evaluate if you can do a 401k plan, if you can afford it, and what the cost is, and even if you have one, get a competitive bid, right? And I don't care who you get it from, right? So no matter what, the competition has gotten so great just in the last 3, 4, 5 years that you might have a 401k with XYZ company, right? A lot of people have ADP payroll, so they have the 401k at ADP. Great, that's fine. They have a great product. But get them on their toes and let's get somebody else to quote you a 401k and kind of see if you can get better pricing,
Sure.
right? Why not? If you don't have a plan, get somebody to do a plan. And by the way, they'll do all this stuff for free. They'll price shop you for free. They'll do a numbers. If you can build a 401k, how much does it cost? They'll do those things for free. Your CPA, the weakness is in the CPA. Okay, so a lot of business owners count on their CPA, and I love CPAs. I don't, but a lot of times they don't have the knowledge or the expertise of the retirement plan. That's probably one of the weakest areas for CPAs, and they'll fully admit it. They don't know all the ins and outs and how much you can do and the difference between this and that and the SEP and the solo 401k. I can't tell you how many CPAs get that stuff confused. That's fine. They know the tax law like nobody's business. That's what they're supposed to do, right? But you need to get with a trustworthy financial advisor, but just get a second opinion, right? Why not? Just like we say the same thing about insurance too. Just as a business owner, go shop your insurance every 2 or 3 years because they typically take you for granted and start doing the increases. So
it's that way in any business. You always want.
It's that way in every business.
Yeah,
Keep them on their toes. Price
Yeah.
shop, compare. What's the value you're getting, right? And then if somebody's offering you, it's not just about price, right? Because it's the value and how is it, and then what other services are they doing? If they're doing your personal wealth and your 401k plan, that's probably a pretty good, pricing model, right?
And I'm going to give
so-
you one more reason to have a 401k and have all these things.
Yeah.
Because as your company grows and you got more employees and the plans get bigger and you're investing money and your investment advisor becomes your friend, it's amazing the bennies that you can get. You get to play golf.
That's right.
You get suites at the TPC, all sorts of things that can be really awesome. But those, of course, are just benefits of building a relationship with somebody long-term that is investing your money and they become a friend. But that's why you price shop a few people, but at the same time, you're going to build a relationship that's going to be there for a long time. So
So this is good. So again, we talk about the 4 pillars of wealth. And this is about how we build wealth. Use your business to generate wealth. How do you do that? The fourth pillar is a business. You got to have a business. You got to have a business that makes enough money to provide lifestyle expenses, pays your expenses, pay down your debt. We talked about the bad debt. Then you want your business to produce excess cash flow. In addition to paying down your bad debt and paying your lifestyle, you want to use excess cash from your business to buy real estate, revenue producing real estate. That can be your own office building. That could be investing in other revenue producing real estate. You want your business to invest in a retirement plan. That's good for you. That's good for your employees. It defers taxes. It forces you to save. Again, it's another pillar to start building wealth, taking the wealth out of the business by starting the retirement plans, right? Then you want your business to generate excess cash flow to generate a wealth accumulation account. That's just an investment account, right? You put money in the stock market that we don't need today, or stocks and bonds. Again, go talk to your professional advice, get professional advice, go diversify. But we're trying to get the money out of the business, right? As we said earlier, if you don't take it out of the business, it'll keep going back into the business and you'll wonder where it went. So this goes into taking money. We take money out of the business, we live on it, we pay off debt. We use some to buy some real estate. We use some to start a retirement plan, and we use some to start an investment account, a wealth accumulation account. Why do we do that? Because if we keep putting it back in the business, we've only got one pillar. And if something goes wrong with that one pillar, your business needs to generate cash so it can fund the real estate, the retirement plan, your wealth accumulation. So then you're building the 4 pillars. Your stool has 4 legs on your stool. And so if something goes wrong with one of those legs, you'll be able to borrow or live off of or use one of the others. So this one was retirement plans for small business owners. I know it's not sexy, but the point is there is tax advantages for you to do that. So we all like paying less taxes. They are very inexpensive to run nowadays. They used to be more expensive. So go get out there, price shop, find a reputable. I like fiduciaries, right? Fiduciaries, people that have your interests at heart. Your CPA and your doctors are fiduciary. Your lawyers are fiduciary. So there are financial advisors that are registered investment advisors that are fiduciaries. That's the kind of person you want kind of on your side of the table. But go get a quote. Let's go get a quote for starting a plan. Let me do if you're a solo person, I personally think you should do a solo 401k. But that's just me. Go look and see what the difference is between the SEP and the regular IRA and the solo 401k and figure out your situation. If you're a business owner with employees, I think you should start a 401k, at least that little safe harbor, so you can put your money away and then you'll have to put some money away for your client. It's good for you. I mean, your employees, good for you, good for your employees. And then if you're really making good money, then you can add these other components, the profit sharing and the defined, I call it the Mac Daddy, and you can create a plan that allows you to save what you're most comfortable with over time. But the whole point is you're just building the pillar. Today was the retirement pillar. But in general, we want you to generate all four, right? And that's what we talk about in our group coaching program, right? So Dave and I run a group coaching program where we're talking about using your business to generate wealth by using these four pillars. If you want to interview for that, it's Matt@profitabilitymd.com, Dave@profitabilitymd.com. We also do our irresistible offer is our profit acceleration. Now we got a profit acceleration simulator, right? So I think we're going to build the link on the page for the profit accelerator simulator, where you can go in and see what adding 3%, 5% changes to 12 little areas of your business, how that can make a dramatic impact on your business. From that, you'll get a customized roadmap and an explanation of what some of these strategies are. Those are the strategies that we teach in our group coaching program, is that you want your business to generate the excess cash flow so it can fund all those pillars that we're talking about, right? So reach out to us and we'll get that done as well. So this is good. I know it's a dry subject, but I tried to make it interesting. But you're right. Not a lot of people know about what retirement plan options are. So,
but it's a good subject. It's a great subject. I don't think it was a dry subject. I think it was a good subject because I think people think it's too hard. But
it's real simple.
Not that hard. Just go out there and get started.
Yep. All right. Go seek professional financial advice. This is not a show for finance. This is go get professional financial advice from your professional financial advisor or CPA or tax person. That's my disclaimer again.
All right.
All right, man. This is good.
Have a good one. See you, Matt.